entitled in the best Morecambe and Wise tradition, "There May Be Trouble Ahead." This February webinar is set against the backdrop that I've already described, but also against a backdrop where you are seeing ongoing struggles in terms of economic performance across a broader range of economies. So what I'm going to look at today, just as a brief overview, are the PMIs and how they're moving, and what that might mean for growth in future months and quarters. We'll then look at inflation, see how quickly we're going to get to the inflation target or even below the inflation target in most of those major economies. We'll look at interest rates and see what the upcoming meetings in March might deliver. We'll look at labour markets to see how they are diverging. We'll look at politics and see the multiple headaches that we're getting out of the UK, the US, and also the Euro area before looking at the foreign exchange markets and asking the question, is this the end of dollar strength? I can hopefully give you a fairly straightforward answer to that. But looking at PMIs, one of the trends that we've seen has been this pickup, this improvement in manufacturing PMIs in the UK, in the Euro area, to a lesser extent in the US, and also in Canada. Now, I think quite a lot of that might be down to two factors. In the UK, it's almost certainly being helped by the recovery after the cyber attack that we saw on a major part of the manufacturing sector in September and October. So that undoubtedly is being helpful, but there's also increased spending going into the defence sector. So I think that's also helping manufacturing activity as the wheels spin up in that particular area. And you can say the same in the Euro area, and you can say the same in Canada, albeit that the Euro area is probably the one that's picked up the least and been somewhat disappointing. But I do think that we will see stronger growth in manufacturing over the course of 2026 in most, if not all, of these major economies. Much different picture in services. So if you look there, you've seen a decline in activity as far as the US is concerned. You've seen a recent decline in services activity as far as the Euro area is concerned. The UK is broadly stable, and Canada is weak. I mean, it's notable how different Canada's services activity reading is to the rest of the major Western economies. If we look at that versus what's happened economically, and economically, probably the weakest performing economy over the course of the fourth quarter was the UK, followed by problems that we saw in Canada, and then the US and the Euro area running broadly at similar paces. But the US's growth rate was very disappointing. It's expected to be 3% quarter on quarter annualized, which would have been around about 0.7 quarter on quarter. It instead came in at 1.4, which is just above 0.3% quarter on quarter growth that it's indicating. So disappointing numbers out of the US, which under any other circumstances would have probably given a shot in the arm to those calling for an interest rate reduction out of the Federal Reserve. But if we look at inflation, it's a completely different picture. So in inflation, particularly in the US, its rate of inflation and the Fed's preferred measure of inflation, which is the core PCE price index, is running in the high twos, and that is inconsistent with the Federal Reserve making additional interest rate cuts, because it's been running up there for a few quarters now. So that number would suggest that the Federal Reserve are going to be cautious in delivering additional interest rate cuts. And yet, if you look at the UK, we've seen quite a sizable fall in core inflation and also headline inflation as measured by the CPI. So consumer prices dropping back quite quickly. And in fact, according to the Bank of England, we're going to be back at target within the next 3 readings. So that potentially gives additional headroom for the financial markets in terms of expectations of interest rate cuts. The Bank of England likely to cut in March, albeit it's still likely to be quite a close vote and really will be determinant on which way the Bank of England Governor, Andrew Bailey, decides to cast his vote. So it could be a 5-4 in favour of a rate cut, whereas February's decision was 5-4 in favour of no change. It might be a 6-3, you might get another dissenting voice switching over to the rate cut camp. But as Hugh Pill said in the Bank of England's Treasury Select Committee testimony only on Tuesday, they have to be cautious so that they look through the trough in the same way as they looked through the hump as far as inflation was concerned. So when inflation was running very high, they didn't raise interest rates too excessively. When inflation is running below, then they shouldn't be emboldened to cut interest rates. They're trying to hit that 2% target, and they want to be certain that they're going to do that over the medium to longer term. If we look at the euro area, one of the biggest problems on their inflation numbers is just how low some of the inflation readings are. And here's an interesting fact as far as the French inflation numbers. They are basically back to levels that we saw after the first pandemic wave in December 2020. So there is a lack of domestically generated or underlying inflation pressures in France. We are seeing a reduction in inflation pressures across a wide number of euro area countries, such that we're currently undershooting target. Now, if that undershoot becomes more pronounced, that would present an argument for additional ECB loosening from current levels of 2.15% on the refinancing rate. One final thing as far as inflation is concerned, mentioned about the US and the UK and also the euro area. Canada still has its inflation rate pretty well anchored around the 2% target level, but we are seeing some signs of weakness in the Canadian economy. So there's still a possibility, albeit it's a lower possibility than that of the European Central Bank, that the Bank of Canada could deliver an interest rate cut in the latter stages of 2026. And so looking at interest rates, I've said here, the UK is on the verge. We think that they will cut interest rates in the March meeting. I don't think the US will. I don't think that the Canadians will. I don't think that the euro area will, or Sweden, or Norway, or for that matter, Mexico will either. And I think risks of Japanese rates rising are probably pushed out a few meetings as well. So what we're really talking about here is a divergence in monetary policy, with the Bank of England moving away in terms of its monetary policy decisions and deciding to reduce interest rates when everybody else is sitting on their hands. Now, that could again have a material impact as far as the foreign exchange markets are concerned, and how sterling trades against a lot of those currencies heading into the latter stages of 2026, but possibly even earlier than that. Over the next 1 to 3 months, we might see some weakness in sterling because of that divergence. The other thing to throw into the mix here is, whilst we're saying that Bank Zico and other central banks linked to the US are probably going to sit tight for now, I still think there is room for manoeuvre there, which would see an interest rate spread narrowing between Mexico and the US, and that US interest rates may actually have to wait until the second half of 2026 before they fall. But I'm still anticipating that there'll be 2 further reductions from here, irrespective of who's in charge at the Federal Reserve, whether it's Powell, who has to continue on whilst the proceedings take place to name his successor, which looks likely to be Kevin Warsh, or whether it is Kevin Warsh, or if it's somebody else. I think the economic and macroeconomic environment and the inflation environment will become more compelling for interest rate cuts in the second half of 2026 for the US. As far as labour markets are concerned, we're seeing a pickup in unemployment rates in the UK. We have seen a marginal pickup in unemployment rates in the US, but it is marginal. And then we're seeing a fall in unemployment rates in the euro area. And as for Canada, Canada's unemployment rate has fallen a little bit, albeit that I'm not sure that the measurement is entirely offering a a clear picture of what's going on in Canadian labour markets. You're seeing a bit of a mixed bag of data. Sometimes it's part-time jobs that are increasing and full-time jobs that are falling, and then that switches around and it's full-time jobs that are increasing and part-time jobs that are falling. So just be careful about the interpretation of Canadian data here, at least in terms of the labour market. The divergence is also obvious as far as what's happening in terms of average earnings growth. So we're seeing average earnings growth slowing in the likes of the UK, albeit it's still very elevated in the public sector. We're also seeing average earnings growth remaining sort of fairly steadfast at current levels in the US and also Canada, but picking up in the euro area. So we'll just keep an eye on that as well, because again, that could be back into the feedback loop as far as interest rate decision making is concerned, and it would make interest rate cuts more or less likely. And then if we look at population, this is another area that I'm particularly fascinated by at the moment, because we are seeing population growth continuing in the likes of the euro area, the US, the UK, albeit all of those are growing more slowly than they were previously. But when we flick over and take a look at what's happening in Asia, things are very different. So population in China is reducing, in Japan is falling, and actually falling quite sharply. Population in South Korea is broadly flat, but expected to fall in the coming years. That is potentially where we're likely to see, again, an additional divergence as far as AI and AI investment. If you are seeing not just the population, but the working age population falling, then those countries in Asia might be more committed to additional AI investment than the likes of the UK, the US, and also the Eurozone. All of those, by the way, are seeing their labour markets somewhat easier to access to get additional labour resources for employers than perhaps going back a few months or quarters. So that again would lend itself, apart from the euro area, of course, which is seeing its unemployment rate fall, would lend itself to an additional reduction in average earnings growth. As for politics, well, where to start with Labour's sort of 15 plus U-turns that we've seen, but that has created a lot of headaches for the Labour Party, and they looked over the precipice at one stage, almost deciding to change their leader and then backing away from that. So Starmer survives for now, but of course, by the time we get to the to 10 o'clock this evening, when the polls close in the Manchester by-election, things could have changed again. And it does depend on how or who wins the election and by how much. So if the Greens were to win, and they were to win by a clear majority, then that could cause Starmer and his government additional headaches, particularly from the centre left of the party. I think the other issue here is, if Reform were to win, it could be written off as, well, this is just a protest vote. But this is in a tremendously safe seat as far as the Labour Party are concerned. They won it with over 51% share of the vote the last time around. So losing it would be demonstratively negative as far as the Labour government is concerned, and reapply that pressure to the Prime Minister and his cabinet as well. Then there are other issues as well for Labour. There's still pressure being brought to bear as far as the Labour Party is concerned to reverse some of the measures that were announced in the budget. One of the reasons that they might be willing to look again is because they've seen themselves enjoy one of the largest, if not the largest, surpluses in January on record. So consequently, there will be those that say, well, there are other things, other pet projects that we think you should be spending money on. And so consequently, you know, you've got this money in your coffers, spend it now, worry about the future later on. But it's not all about the UK. There are problems also in the US, and we've seen the Trump administration facing issues around the Department for Homeland Security, which is currently not being funded under the temporary funding measures that were agreed a few weeks ago, because their funding ran out back on the 13th of February. So they've gone a couple of weeks now without any funding. And that means that the ability of ICE to go after illegal migrants has been reduced. And not only that, but we've seen controversy over ICE deployment in a number of major cities and court challenges to a number of the migrant deportations. So there's quite a lot there to unpack for the Trump administration, but it's not going smoothly there at all. Trump also is seeing his approval ratings dip. There are worries around the economy. There's worries about the equity markets, and the equity markets have been under a little bit more pressure. That public dissatisfaction is nothing like what we're seeing in the UK, but it's dissatisfaction that is being voiced in his popularity just falling a little bit. So we'll keep an eye on that. Of course, the Supreme Court dealt him a blow over his IEPA powers, which they say he's overstepped in terms of the deployment of them. And there's still currently a Supreme Court ruling outstanding on the case to have Lisa Cook, the Federal Reserve governor, dismissed from her position, whether Trump has the power to do that. There are other things that we're still waiting to hear back on. The deals that were in their infancy with the likes of the Euro area, India, the UK, and Japan may now no longer be valid because of the change in tariff policy. And there's still a deal to apparently be done with the Chinese, but neither side appears to be rushing to do that deal. And then finally, if we look at the Euro area, well, in the Euro area, it's all about the 2027 presidential elections in France. Yes, I mean, we're talking about something that's more than a year away, but it's having direct implications on what's happening now. So the Bank of France governor, Villeroy, has decided that he will step down early in order that his successor can be named ahead of those French presidential elections. A similar thing might be happening with the European Central Bank president, Christine Lagarde. So she might step down in order that a successor, most likely to be Klaas Knot, the former Dutch central bank head, to step in ahead of those elections as well. And it's not just about France. Let's be absolutely clear here. The German government is unpopular, even though they're spending more money and potentially levying some tax cuts into the bargain. The Spanish government can't pass a budget, haven't done so in the last 3 or 4 years. Italy is struggling in terms of economic growth. So is Germany, so is France. In fact, it's only Spain that appears to be doing particularly well in the Euro area at the moment, which is why that sluggish rate of economic activity might compel the European Central Bank to reduce interest rates again. And then if we look at the foreign exchange market forecasts, will the US tariff ruling by the Supreme Court make a difference to the dollar? Well, given that the initial implementation of the tariffs saw the dollar sink, there is the question, why isn't the dollar rallying at this point? Even with the new tariff regime that's been announced, which is only 150 days that it can run for, and it's only in situ as an emergency act until they do the work on a variety of different economies to justify any tariffs levied. I do think that there is an argument for a stronger dollar. If not that, then the fact that the Federal Reserve might be more belated in reducing interest rates further. So they might be lagging behind what the Bank of England do. That could offer the US dollar some additional support against sterling, and also against the euro. We might see a case being built for additional interest rate cuts out of the European Central Bank over the coming months. And so by the time we get that initial an additional interest rate cut from the Federal Reserve for 2026, the European Central Bank might be seriously considering reducing rates themselves. What about intervention risks from the Bank of Japan? Well, it's all talk at the moment, whether it's the Japanese authorities or whether it's the US authorities. They've not done anything. They've talked about it. They've maybe warned people about it, but they haven't done anything about it. So we'll wait and see whether or not that is something that will manifest itself over coming months. And the Japanese yen situation is further complicated by the Japanese Prime Minister Takaichi, who seems to be much more liberal in her approach to spending public funds. particularly around trying to boost growth, so get growth running hotter than it currently is. She's also intervened in recent press reports, at least it's been alleged that she's stated that her position is that she doesn't want the Bank of Japan to be increasing interest rates any further. That would impinge on the Bank of Japan's independence, wouldn't be seen as a positive, and I think could lead to additional pressure being brought to bear on the Japanese yen, which had actually rallied a bit over the course of the first few weeks of February until we saw that intervention recently over the last sort of 24, 48 hours. Will safe havens continue to benefit the likes of the Swiss franc and gold because of the pressures that are being brought to bear on a whole raft of currencies around the globe, but particularly the major currencies of the US dollar, the euro, and things like the pound as well. And then one other question is, will the Australian dollar continue to outperform because the Reserve Bank of Australia are raising interest rates? I think that there's at least one more rate increase due from the Reserve Bank of Australia, and that ought to be reasonably supportive for the Aussie dollar throughout the remainder of this year. It might not mean that the Aussie dollar strengthens any further, but I think it'll hold up better than some other currencies that we've likely to see additional rate cuts from, naming the Bank of England and therefore sterling as one of the most obvious.